Good afternoon, everyone, and welcome to the New York Alternative Investment Roundtable monthly call for October 2020. I'm Robert Atkinson of Mirae Asset Securities Prime Brokerage, the moderator. We are very pleased today to welcome Daniel Oliver. Dan is founding member of Mermican Capital, LLC, which is active in the junior gold and silver mining sectors. Previously, Mr. Oliver worked at Baring Capital, LLC, a private equity firm in Buenos Aires, Argentina, and focused on Latin American commodity investments. And prior to that, practiced law in the corporate division of Simpson, Thacher, and Bartlett, LLP. In addition, Dan has co-founded two venture companies and is completing a book on the history of credit bubbles. We look forward to that, Dan. He is also a director of Van Gold Mining Corporation, president of the Committee for Monetary Research and Education, and is a frequent speaker on the topics of gold, banking, and credit bubbles. Dan received his bachelor's degree from Vanderbilt University, graduated from Columbia Law School, and obtained an MBA from INSEAD. The title of Dan's talk today is Gold at $10,000. Sooner than you think. But before we dive into this interesting and very relevant topic, I do want to take a moment to thank our sponsors for their ongoing support of the Roundtable and this call. They include, you can see that slide there, Alston Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Mirae Asset Securities Prime Brokerage, Kaya, the Grand Duchy of Luxembourg Trade and Information Office, and the Department for International Trade of the United Kingdom. Now, just a reminder to everyone, Dan will be answering my questions for the immediate future, approximately 45 minutes or so. But I do want to call your attention to the facility on the screen. You will be able to, as usual, ask questions by going into that chat room, and I will promptly pose them to Dan. One other programming note before we begin. I do want to remind everyone that we will be having our fall virtual cocktail networking event later this month. So please join us for that event, and I would encourage you to consult the website for more details. So let's get to it. Dan Oliver. Gold at $10,000 an ounce, a very bold prediction. Now, I'm sure that our audience, both listening and viewing, are very interested to hear how you arrive at that, and perhaps most importantly, when this will take place. But maybe it makes sense for you to take a few moments to explain the intellectual underpinnings of this investment thesis. So Dan, if you would, please do that.
Yeah, sure. I mean, the $10,000 per ounce call, I think, is actually very conservative. And I understand that there are lots of late night TV people who wave their hands and try to get you to buy coins with no real explanation as to why it would go there. And so I'd like to talk about the why. I think it is fairly simple once you understand the basic principles. As recently as 2007, I was a gold skeptic, mostly because I'd never thought about it. I'm sure you know that Milton Friedman and Warren Buffett made the comment that gold mining makes no sense. You dig gold out of a hole in South Africa or someplace like that. You transport it at great expense to somewhere else. You dig a new hole, a vault. You stick it down there and you pay people to stand around guarding it. It makes no sense. And that was basically my opinion. It had no utility. Until I started really doing the research after 2008, when the world melted down and gold did very well. And it doesn't take a lot of work, like you do your own work, because no one will teach you this at school or anywhere else, that gold has utility. And its utility is as money. It acts as free market money. And the guy who figured this out, actually, interestingly, wasn't until the late 19th century. People had used gold coins for thousands of years, but no one really knew why gold and silver had behaved as money. And Carl Menger, the founder of the Austrian School of Economics, figured it out. But he posited that if you live in a state of barter, it's very inefficient. The direct trade is very easy. You have coconuts, I have fish, we make a swap. It's very simple. Once the economy gets more complex, those sorts of trades become impossible to do. When you think about a supply chain, intermediate goods, there's no way barter works. And so what the market wants to do is find what he called an intermediate good. You don't trade your good for the thing you actually want. You trade your good for the thing that has the least transaction costs in trading. Because once you own that thing, you can use that new commodity to go buy the thing you do want. And so what the market does by itself, except when the government gets involved, what the free market does is it looks for the thing with the least transaction costs to behave as money. And the properties of gold and silver lend themselves to this very well. Gold is completely unique in history because it's both scarce, it's also widely distributed. If you have something very scarce, no one else has it, it's hard to trade with it. But it's scarce, it keeps the value high, and everyone has a little bit, the rings, jewelry, all those sorts of things. And so that makes your trading parties very broad. It doesn't decay, it doesn't oxidize. So gold stays just as shiny in the bottom of the ocean as shipwreck as it does in use or anything else. So it doesn't decay at all. It's very easy to identify because it's so heavy per unit mass. It's a very dense material. So you know in your hand you've got gold because there's no way to fake it, or there wasn't until the last couple of decades. And so for these and many other reasons, the market gravitates towards gold as money. And so gold, again, it becomes money through market processes, as Menger said, as the market tries. Grain was the most liquid item originally, then copper, then silver, and then eventually gold. And just a quick sidebar, because people like to think about gold versus silver. What the function of silver has been for the last couple thousand years is as a transactional metal. So you go to the grocery store and you buy food, you're using silver because gold is simply too valuable. It would be very tricky to have little tiny grains of gold and trying to get an exact change. Whereas if you're trying to ransom your king back or buy a ship or a building, use gold because there's so much value. Silver would have to come in big chests, and obviously gold much easier. So gold and silver have this dual nature of a transactional metal for silver and a capital metal for gold. And
go ahead, Dan. I'm sorry.
Oh, so and this has tremendous implications because, as we'll get to later, when a credit bubble pops, you can have various outcomes. For example, in the 1930s, when we had a deflationary credit collapse, silver didn't do very well because the dollar was still well backed and transaction was no problem. What the problem was the capital being destroyed in the market and the banks. And so gold did very well, silver did very badly. Whereas in the 70s, when we had an inflationary credit collapse, they both did very well because the banks, you put your money in a bank, but you had negative real interest rates, so you were losing your capital in the bank, and also transactionally, the dollar was collapsing so quickly that no one wanted to hold dollars, so therefore silver did very well. So if you get to look into monetary history, you can get some more insight into how these things work. If you look at the way banking systems develop throughout history, and again, you can trace these themes back thousands of years, not hundreds of years, thousands of years. The market chooses gold as money, and then banks show up and they say, hey, transacting gold is very, very inefficient because each gold coin is a little bit different. It wears and each prince is a different standard. And so the original function of banks was they would accept coins, they would assay them, measure them, and then print banknotes out. And the banknote was better because you knew precisely how much gold that banknote represented. And so the market preferred those things to the gold itself. And that's where paper money and banknotes developed was because the market through banks was adding liquidity to the market. And as we all know, the next stage of the story is that eventually no one goes and redeems their notes for gold, because why would you? Because the note is always more liquid than the gold, and eventually there's some crisis, there's a war, something happens, and the authorities or the bankers say, hey, you know what, we're going to suspend redemption privileges, and so then all of a sudden the banknotes are separated from the gold that's backing them. And again, that's what happened in this country in 1933. And through 1933, you could take your Federal Reserve notes and go down to the Federal Reserve and say, I want my gold, and they give them to you. And then after that, FDR made it a felony.
So Dan, it sounds to me, if I'm understanding you correctly, that what makes gold so special is that it's real money, right?
It's free market money. That's right. That's the market chooses gold as money.
Right.
In the absence of politics.
Right. So we'll call it free market money. But one of the definitions of money that I think many of us have come to accept is that money acts as a medium of exchange.
Correct.
A unit of account, a storehouse of value.
That's right. Okay?
Now, based on what you've said, and I think we could probably all agree gold certainly, to one extent or another, is a storehouse of value, okay? But in terms of it being, meeting the other qualifications of money, a unit of account or a medium of exchange, it doesn't really fit that bill, at least currently, because it's been demonetized, right? So it is not legal tender, to my knowledge, any place.
Well, that's a really good point. And again, let's go back to the distinction between gold and silver. Remember, silver was always a medium of exchange. Gold never really had that function. It had a function of capital preservation, where you store your capital. And so I think that doesn't really qualify for that. In terms of gold being money, again, what is money? Money is the most liquid thing. And one of the interesting aspects about gold, thinking about gold as money today as a unit of account, is it still is. And let me give you an example. If you look at the price of oil since 1971, when Nixon, quote unquote, demonetized gold, the 12 month rolling volatility of oil in dollar prices is 64%. If you price oil in gold terms, it's only 40%. So even though gold is not officially money, it actually shrinks the volatility of commodities. So if you are in the commodities business, if you're producing copper or oil or anything that is a commodity-based business, you should be keeping your books in gold terms, because it reduces volatility and gives you a better sense of value. Now, no one does that for various tax reasons, and because, as you say, politically, legal tender, and all that business. But economically, it makes more sense to do that. And I would suggest to you that in South America, when you have high inflation, like in Argentina, where I lived at one point, they used to apparently keep 4 books. They keep them in terms of the local currency. They would keep them in terms of inventory. They would keep them in terms of dollars. And they have a 4th set of books for the government to pay taxes with. The one that was made up. So the point is, people can think about money and units accounts in different ways. And in fact, if you were in the commodities, if you're selling candy, it's a different thing because you're so close to consumer. If you're close to commodities, you should use gold as a unit of account because it is free market money and it still acts as such. And this makes sense because which of us think that some politician can demonetize free market money? You can certainly, lots of countries like Kublai Khan and Hitler and can make Napoleon, Robespierre can say gold's illegal, and if we find it on you, do Diocletian made owning gold a capital offense, they can do that, but they can't overrun the rules of the market. The markets say when the market is free, the market will choose gold as money.
Sure. And let me ask you one follow-up question.
Sure.
Previously, you said something that really intrigued me. I think what you were inferring was that the transaction costs for gold are low. Is that accurate?
Correct. Compared to other things, other physical commodities. That's right.
Because I know. So, and you also made the comment about people selling coins on television. So again, maybe this is a little bit of a diversion, but we might want to distinguish between bullion and numismatics here, right? If take bullion, right? So if you've gathered or assembled or collected gold bullion, it's not that easy to sell it, is it? Or is it?
Well, again, physical gold has never been all that liquid. It's what the way the market used to work is you would deposit your gold at a bank and they would give you liquid notes for it. Today, gold coins are not particularly liquid. They're more liquid than things like diamonds, right? I mean, there's what a 3-4% spread in the retail market, which isn't bad for a physical object. I mean, you go try retail, you sell your toaster after you buy it, right? The spread for most things is tremendously wide. But if you look at the wholesale markets of gold, right, the bid-ask spread is I forget 0.0001%. I mean, you're looking at $1 when it's $2,000 an ounce. So the spread in the wholesale markets, again, when you're dealing with capital flows, is extremely tight compared to other things.
Okay, so let's get back to the investment thesis. Gold at 10,000. Okay,
right.
So what circumstances need to occur?
Let's go there. Sorry, but so having established the gold free market money and having established that what currency really is gold is they start as gold-backed things and then they separate their redemption and the central banks become their own independent entities. What Well, we can talk about that, Bob, or we can talk about the credit cycle first, which I think makes more sense.
Please, yes.
Having established goal is money. So what happens is that once the central banks are freed from the discipline of gold, remember, if a central bank in the 19th century tried to print too much money to buy too many government bonds, what happened is that the people who received the paper could run down to the central bank and redeem them, and the gold would flow out. So the central banks were not free to do what they wanted to. They were constrained by the market. And up until the 1930s, you could have runs on central banks. People could run down to it happened in the Great Depression. People ran to the German central bank, the Austrian central bank, and said, "Here are my currency. Give them my gold." Right? And
those are referred to as panics, right?
Well, panics, or a run on a central bank. I mean, like a bank or central bank, same thing. And so in the 30s, when they prevented people from doing that, right, it liberated the central banks under the new Keynesian framework to print money. What printing money does, they don't really print money and drop it from helicopters, or at least not yet. What they do is they print their money and give it to the banks, right? And if we think, again, the commercial banks. And commercial banks use the reserves, and everyone listening to this podcast knows, the banks today operate under the fractional system. So you deposit $100 in a bank, they lend me $1,000, right? 10 to 1, it's more like $50,000 if you're talking about treasury bonds, but let's not go there. So the banks don't distribute credit, they create credit. And when you create credit, when the banks create credit and lend to people buying assets in the market, what happens is asset prices go up. And this is just math. If asset prices go up in the context of steady cash flows, it's another way of saying that discount rates are going down. It's just math, right? And when discount rates go down, it has a very particular effect on the economy, which is that if you think about a discounted cash flow, the lower the discount rate goes, the more affected projects are the ones that have high capex and long-term cash flows. So things like buildings and ships and mines and airplanes and all those big things. And so the prices go up not because consumers want more of them, but because the banks are willing to finance them. And a rising price in a free market is supposed to signify scarcity. And so not surprising, the market entrepreneurs, companies run out and they start constructing more of these things because the prices are higher. This puts tremendous pressure upwards on employment, which is great. Policy, who doesn't like that? Commodity prices, because building buildings and ships and those things take a lot of commodities generally. And so you get overcapacity in these items, because again, this isn't driven by consumer demand. It's driven by the banks creating credit to redirect effort into these high capex things. And then once you have overcapacity, cash flows go down. And as I'm sure everyone wonders still, the Fed printed so much money in 2008. Where was the inflation? And what happened to consumer inflation? It didn't happen. Well, it didn't happen because that money, what they were printing money was to give to the banks. The banks created the credit to build more capex, and more capex, more capacity lowers consumer prices. So that's why consumer prices didn't take off in those particular parts of the economy. But what happens is when you have overcapacity is your cash flows go down, and then you can't make your debt payments, and then the banks blow up. Right, and then everyone goes bankrupt. In the 19th century, that was the story. And then people who hadn't gone crazy picked up the remnants of the bubble, and they re-rationalize activity. Today, we have central banks, and the central banks print up the money, and they give it to the bank to recapitalize the banking system. So the banking system becomes immune from this process, and they go and lend even more money to the process again, which is why after 2008, the panic, right, the Fed printed all this money, they bailed the banks out, and the banks all of a sudden had reserves again, and they could start lending money, and the bubble activities took off immediately. I mean, I fled New York recently, but anyone's been to New York City recently, until a year ago, buildings everywhere, much worse than the bubble in the 2006-07 period. So that's the basic model. And one of the things that the Fed has to do is they have to keep printing money at an accelerating pace, because they have to keep these projects alive that shouldn't be there. The consumers don't want these things, right?
But Dan, that's not what we did in the 1980s. Didn't Volcker take a very courageous stand?
Well, yeah, he did. And what happened was we had the biggest depression since the Great Depression. And if you recall, by 1982, it looked like Reagan was on his way out because people were so mad, and the Congress wanted to ditch Volcker. It was a real disaster. Employment went really high. So he did do that, and it was very good. But even Volcker, when the banks started to wobble, he got religion, and he started, and rates came down pretty fast at that point. Although we did lose a lot of banks. The S&L crisis.
Is the situation that you've described retrievable, or is it irretrievable?
Oh, well, no. I mean, in the 70s, what happened there was that the inflation of the 70s had eaten away a lot of the real debt. right? Because if you issue a bond and inflation kicks up, then the value of it goes down. So you can withstand that kind of treatment. Today, I mean, can you imagine what would happen if the Fed raised rates to 20%, short-term rates to 20%? I mean, banks would collapse, private equity firms would collapse, the market would collapse. I mean, it's unimaginable
So
because there's so much more debt today than there was in the 70s, in the late 70s.
Can rates ever go back up to even 6, 7, 8%?
Well, no is the short answer. I mean, they can and they will, but the policymakers will fight that as much as they can because, again, every time rates go lower, it creates a whole new class of activities that don't make sense. But for consumers don't want these things. But the banks are able to fund more and more submarginal projects to keep them alive. And so the Fed has to keep printing money and giving it to the banks so that they can keep lending money to these projects. And one of the things we were talking recently, right before this started, was that if you look at the Fed's balance sheet size, it is a parabolic curve or hyperbolic or whatever the mathematical shape is.
Hockey stick.
It's going like this because it has to go higher. And if you look at the curve of the Fed's balance sheet, they tried to hop off twice. They stopped. They didn't stop increasing the balance sheet, but they slowed the rate of acceleration in 2005, 6, and 7. And then, of course, 2008 happened because the banks needed that credit to keep the bubble alive. And then, of course, Bernanke printed like crazy, get back on the exponential curve. And then what happened? Powell, in the last couple of years, tried to hop off that curve, right? The Fed's balance sheet started shrinking, and that worked for a bit of time. But then, don't forget, the wheels were already popping out in September of last year, long before the virus showed up. The repo market blew up mid-September of last year. The Fed ran in to say the repo market, and they said, oh, this is temporary. But then, of course, they had to stick around at the end of the year because the end of year rebalancing, that was temporary. They never got out of it, and the virus hit. And then now we're back on the exponential curve. So again, as we talked about, von Mises and the Austrian schools predict this, that they have to keep printing at an accelerating rate. And so, again, we're getting nearer to the answer, why is gold going to 10,000? As a start, and the reason is because the Fed simply cannot get off that exponential growth curve of money without blowing up the entire banking system and the entire economy with it.
And so, hang on one second. I have a question from the audience. So if a president, assume for a second that Vice President Biden wins the election, pumps $3 trillion into the market.
Sure.
As Trump has already done.
Yeah, that's right.
Would that increase the chances of us getting to $10,000 gold?
Well, I can explain it in a second. We're getting there anyway. But the one of the things to think about in terms of when gold is going higher is gold doesn't like a credit bubble. And let me explain. As I mentioned, a bubble by definition is when rates go down and asset prices go up because cash flows become worth more in that environment. But gold has no cash flow, as the detractors point out, right? And it's not used in industry. So gold always underperforms in a credit bubble. And that's why from 2000 to 2008, gold did great. It went up 4 times, whoop-de-doo. Oil went up 13 times. And so gold underperformed other commodities. And then in the crash, it's true, gold got hit from 1,700, got 30% in the initial crash in 2008. Oil went down 80%. And then within a few months, gold was back to $1,000 an ounce, it's back to its all-time high. And oil's never gotten back to the all-time high. So if the Fed is able to engineer a new credit bubble, as they did from 2000, call it 11 to 2000, 18, 19, gold does not like that, and it does badly against other things. And I know we're going to talk about gold mining later, but just a quick preview. What a gold mine is, it's a spread trade between industrial commodities and gold. So your input costs are oil, steel, labor, rubber, all those heavy commodities, your output is gold. And so what you care about is the relation between those two things. And so in a credit bubble, all those commodities are going up while people construct these heavy CapEx items, gold isn't, and so your margin squishes. And then in the collapse, like the 1930s, 1970s, 2009, 8, and 9, commodities collapse in terms of gold and your margin explodes. So to answer the question, I think in Biden's case, if he prints $3,000, it does accelerate the gold's path higher. And the reason is because what the Fed did in 2008 and 2009 was, as I mentioned earlier, they printed money to give it to the banks so the banks could lend money to businesses to construct assets. Today, what the Fed is doing is it's printing money to give to people to meet their current expenses, right? The government said, okay, no one can work anymore. The hospital can't work. We're not going to allow your income to suffer so you can consume the same amount as you were consuming before. So we're going to print the money and give it to you so you can consume as much. Well, I mean, this just says law, right? A society cannot consume more than it produces. So if you take production offline, consumption has to go down. So if you print the money to give to people to consume the same, all it does is increase consumer prices. And that's what we're seeing in food prices going bananas because of this dynamic. And what Biden...
But Powell jumped into this before the virus hit, right? So if you go back to the summer of 2019,
yes,
he was already trying to juice the economy up.
Well,
so when the virus hit, then he laid on another.
But let's distinguish between a credit inflation, which is what the Fed's been doing for the last few decades, right, in the 80s, 90s, and aughts, in the 10s, to a debasement of currency. And the distinction, again, is when the Fed buys bonds the banks are holding to give the banks new reserves, they go lend money, and it juices the stock market, juices the bond market, juices construction, employment, all that Keynesian sugar high stuff. It's great, right? When they print money to fund current expenditures, they give it to people like the helicopter money, and the little people get the money and go spend it on food and lodging, whatever they're spending money on, right? That's debasement. That is just destroying the value of the currency itself. And that was the story of the 70s. And so my point is that if you look at a year ago, the Fed was funding the banks because of the repo market business, right? That was credit inflation stuff. So when the virus hit, they started printing money to help people pay for their current expenditures. And that is a that is a monetary debasement. And that's a very different animal. And what the left will do if they have sweep next week is they are interested not in the banks, they're interested in sending money to their constituents. Obama phones, Biden is proposing free houses for everyone, I mean, that kind of thing. So that is straight debasement, not credit inflation.
So Dan, we have another question in from the audience.
Okay.
Gold does have industrial uses, and in some nations, gold is used for gifts and for showing off. If gold gets too expensive, does that demand shrink for gold?
Well, it's a good question. Gold's industrial demand is tiny compared to how much gold's above ground. Again, people don't throw their gold out. So when Pharaoh died, they put all his gold in a big pyramid to keep people out, and people got it anyway. I mean, so basically, nearly all the gold ever mined in human history still exists above ground, and so the entire gold mining industry globally increases the above ground supply by about 1.5% per year. Now, the Fed says it wants 2% inflation, right? But of course, the balance sheet moves more than that. Gold actually produces that because it increases by about 1.5% per year. And that's one reason the supply is so incredibly stable. So that there is a minute amount of industrial use, but it doesn't affect the enormous amounts of above ground supply we have. In terms of gift giving in any place like that, it's not you don't consume it. The same thing. I think the wife in Italy gets a jewelry, right, and that's the dowry. That's the family savings around her neck, and so it doesn't get consumed. It's still there. It's capital.
And I think this question really is a very interesting one, in that, and I think you were alluding to this earlier, the use of silver, right? Yeah. Poor man's gold, right? So,
kind of.
Let me ask you this:
transactional metal instead of capital metal.
Sure. Right. So gold was the medium of exchange between sovereigns. And it was cumbersome to carry around, and that's why, right. So silver and banknotes came into existence, but silver really became poor man's gold. And I don't know if you subscribe to that view that as gold spikes up in price, people who no longer can afford gold, as the questioner was inferring, turn to either they don't buy gold or they buy a substitute for gold. And silver traditionally has been such a substitute. Would you agree?
Yeah, maybe. Again, I think that serve two very different functions. And again, the example I give is in the 70s, from what I'm told by grizzled old gold coin dealers in New York City, cab drivers and laundromats would show up every day in the day and take their dollars and convert them to silver. Right, because again, it was transactional. I didn't want to hold the dollars overnight or for long periods of time because it was depreciating so quickly. And again, in Argentina, places like that, they use pesos, but they store their money in dollars, right? And they use pesos as transactional currency. So that's the function of silver. I suppose if gold gets really expensive, again, that probably indicates the dollar is depreciating. So silver would go up not because people can't afford gold, because the dollar is simply going down. So therefore, everything will be going up, or everything that when the dollar collapses, the market may not go up, may stay where it is, because the value is going down in real terms. But in real terms, things will go up in price. That's
yes.
correct.
So here, Dan, we have another question from the audience, which I think you'll appreciate.
Sure.
What is the most cost-effective way to own gold? Should you own it? Should you own the physical gold? Do you want to own paper gold? What's an appropriate proxy? And what factors should prompt you to sell and take profits? And what are the tax consequences of the various ways you can own gold?
Let's dial it in a couple of different parts. In terms of owning gold, I think you want some physical gold, in your house or on your person, whatever it is. And that's really insurance money. I mean, people use
coins or jewelry.
I mean, coins are more liquid, right? I mean, you show up with an ounce coin, and I was saying it earlier. And to most of human history, you couldn't fake gold because it's so dense, and nothing else is as dense as it is. And so you know immediately it's a gold coin. Today, platinum is as dense, but platinum is worth so much money. No one fakes a gold coin using platinum. And tungsten is also the same density, and that's not nearly as valuable. But they found tungsten cores and bars. I've never heard of a tungsten coin because, again, the core bits are so tiny, to be very expensive to make. But anyway, people have lots of stories. I know people, older people who were smuggled out of Eastern Europe using gold coins. I mean, not that I think we want to be too historical about it. That happened in the U.S., having smuggled out to Canada or Mexico. But the point is that having it on your hand makes sense. If you're worried about civilization collapsing and buying crops from the farmer, silver is a better bet because, again, that's a transactional metal. So gold is really to preserve capital, and so you don't want too much. You don't want $1 million in your sock drawer and on your bed. I mean, you only a certain amount in your person. So I think the next best thing is don't keep it in a bank because they'll shut the banks, and that's what FDR did. They'll do it again. It's to store it in a company that gives you a one-to-one relationship to the gold being stored.
That's paper ownership.
I don't know if I work a little bit with Simon Mikhailovich, who runs the Bullion Reserve, and he's a very elegant system where he keeps your gold in Zurich, and you own it directly through an LLC, and so it's offshore, but you're onshore for regulatory tax purposes. You're offshore physically, and those sorts of one-to-one relationships, as opposed to other companies where you put your gold in, you have a claim on it, but you really have a claim to the company that owns the gold. So then you've introduced a counterparty risk, and you want to try to minimize it as much as possible. So I think, again, small amount of physical in your person, in a vault, a non-bank vault, if you can manage that, but that's difficult to do. A company that gives you a one-to-one relationship with you and the gold, and then less good than that, or really easier, is these companies that will store for you and reclaim on the company.
But if I may interject, Dan, basically all of the solutions that you've proposed here stop short of an absolute meltdown in both society and the financial system, right? So if you hold the gold on your person, that's one thing.
That's right.
But if you're holding any type of claim, which is paper, right? You're relying on a third party, right? You're relying on the financial system remaining, the integrity of the financial system.
Well, that's right. You have to decide how crazy you think things are going to get. In other words, if we're going full Bolshevik, they're going to put us up and shoot us. Well, that's a different story. I mean, I don't know what you do then. You run for the hills. Who knows? Right?
Guns.
I mean, there are people in the gold bug community who are all survivalists into the woods. I'd last about 16 minutes in the woods, so I'm not worried about that outcome because I just can't worry about that kind of thing. So I think about what are likely outcomes. As I think we'll get to, in the 1970s, gold went up 35 times. So another way of saying the dollar depreciated by 97.5%, and the world didn't end. It was depressing. It was a unpleasant era, and malaise, and all the movies were depressing, and all the rest.
Good music.
Depressing. Well, go watch Incredible Hulk. The soundtrack is so depressing. Oh my God! But we survived. I mean, it was okay. And countries that live through these experiences don't disappear. What does happen is, often people who are rich going into it are not rich coming out of it. That happens a lot. But the country they don't collapse in revolution usually. I mean,
which, by the way, I think a lot of people on this call would be very interested in hearing your views in terms of not only how gold gets to 10,000 and in what time frame, but how to preserve wealth in a volatile environment.
Sure. Let's, because I want to go to the last question. When do I know when to sell? And that's the pertinent question. I want to go back to the main theme of our talk, and that is, as we before we start some Q&A, that we were talking about how the Fed has to keep printing at an accelerating pace to keep the bubble alive, to keep rates from keep them falling, to keep the banks from blowing up. And the problem the Fed runs into is it runs out of assets to buy. If you look at not just the size of the Fed's balance sheet, but the makeup of it. It began in 1914. I think its first balance sheet was 14, began in 1913. It was mostly gold, 84% gold. And they went and they bought commercial bills or 90-day invoices, not corporate debt. These were invoices.
Trade claims. They bought
trade claims. Yep. So very solid 90-day limit on maximum duration, and also very short government bonds. And then, of course, they were immediately converted to financing World War I, which is a problem, but they stuck out of that, and then we got the panic of 1921. But basically, until the 30s, through the 30s, the Fed's balance sheet looked like gold, commercial claims.
But just a quick question.
Yeah.
Are there any restrictions on what the Fed can buy?
Well, I'll get there. So originally, that was it. The original charter was short-term government bonds, 90-day invoices, and gold. That was it. That's all they could do. And then when World War I showed up, they changed they didn't allow the Fed to buy Liberty bonds, but they did allow the Fed to lend banks that were then issuing Liberty bonds. So it was the same sort of thing. So they expanded this mandate within the first year to fund World War I. When they got to the Great Depression, right, the Fed was allowed to start buying longer-term government bonds and more exotic things. And so its makeup of gold started declining from the 40s. Actually, by the 40s, the Fed's balance sheet was 84% gold again by 1940 because of the Depression, interestingly. And then the Keynesians took over. And that was a point, again, when Americans couldn't take their dollars anymore and redeem them for gold. And the ratio of gold backing the Fed's assets went from 84% at 1940 to 12% by 1968. The Nifty 50 and all that, the 60s stock market bubble, that was because the Fed was, again, buying bonds to give reserves to the banks. The banks could go lend money against stocks and industrial concerns, all those sorts of things. So that was a low point, 12%. You look at the Bank of England, it was the gold backing was a third for 300 years, and the Fed was 50% actually for the first few decades of its life. By 1968, it was 12%. And what happened in the 70s, and no one thinks of this way except me, I think, but the price of gold went from $35 an ounce to $875. Well, in 1980, when gold hit $650 an ounce, the Fed's balance sheet was 100% backed by gold. You look at the gold in their balance sheet, you multiply by $650 an ounce, right? It was 100% backed. So the market had put us back in a gold standard. No one thinks of it that way, and politicians didn't get religion and say, okay, about gold, but the market did it, right? And so now, and then the monarchs took over. The monarchs are just Keynesians, with a different name. They don't like physical stimulus, but they like everything else. And they started, again, printing money, buying government bonds. And that ratio of how much, by what percent gold backs the Fed's assets went from 100%, over 100% in 1980, down to today where it is at 6%. So gold, from the perspective of the Fed's balance sheet, is half the price that it was in 1968 at $35 an ounce. I mean, you should think about that. It's basically trading at $18.50 in 1968. That's where it is today, right? And so, to me, it's not just the size of the balance sheet; it's what makes it up the balance sheet. And not only is gold only 6% of the balance sheet, but what are the other assets, right? It's not 90-day invoices. It's not short-term government bonds, right? What it is it's long-term government bonds, 30-year bonds that these things are buying, fixed-rate 30-year bonds. It's funky mortgage-backed securities. Right now, it's corporate debt. And to your question, the Fed has no authority to buy corporate debt. So what do? Well, they form these joint ventures with the Treasury Department, and the Treasury puts in 10%, and the Fed puts in 90%. And then this JV thing, the special purpose vehicle, that goes and buys the corporate bonds. The Fed says, hey, we're not allowed to do it. We're not doing it. But of course, the thing that they are 90% financing is doing it. And by the way, where does the Treasury get their 10%? Bonds, the Fed buys. So of course, the Fed's actually funding the whole thing. So it's just an end run around the regulation. So now the dollar is being backed again by these weird things. And so I think some of the debt they're buying isn't even investment grade. And so when you think about where gold has to go, it's not just, I'm not a quantity theory of money guy. It doesn't matter to me how much money the Fed's printing. What matters to me is what are they buying? What is backing that thing in their wallet called a dollar? And it is pretty shaky assets. And so if and when, I think when, the Fed loses control of real interest rates, right, and rates are going higher, the things that they own are highly, highly interest rate sensitive. The lousy bonds they're buying, the long-term government bonds, the mortgage-backed securities, right? And so if you think about what percentage will the market demand that back can go to. And let's go back to what I said earlier. In the old days, you could go to the bank and say, here's my paper, give me gold. Well, you can't do it anymore. What you can do is you can go to the coin shop and say, I don't want these dollars, give me gold, right? And so the price of gold will go to a price that balances the Fed's balance sheet the way it did in 1980. That's going to happen. That's the market reasserting itself and saying, hey, politicians, we're tearing up a credit card. We're using real values now, and that's where it's going to go. And when you look at the gold price from that perspective, right, $10,000 only gets you to about 35% backing, which is what the average was for 400 years. So that's not panic stuff, right? And so there is a argument to be made that a panic number could be up $20,000, $25,000 an ounce. That's not equilibrium, but that's where we got in the 80s as a panic high, and there's no reason things are much worse now than they were then, that we can't get there again.
So Dan, on that note, we have a question from the audience.
Sure.
And you as a student of history, I'm sure will appreciate this.
Okay.
You will recall that FDR not only could close the banks, but did in fact close the banks.
Correct.
Making it illegal to hold gold.
That's right.
As bullion. Okay, not numismatics, but bullion.
That's right.
So the question is, does the government retain that kind of power right now, and to what extent does the as you would say, inexorable climb of gold to whether it be 10,000 or beyond, how does this government power influence that?
Government power has only increased since the 30s. I mean, obviously. So, I mean, whatever they could do in the 30s, they could do a lot more now.
To expropriate that asset.
Sure. That's the Cyprus solution, right? Where they just say, okay, all the banks are closed. All right, we're going to wipe out all balances above $100,000 or whatever the number is. And no, I think that's very possible. But I wanted because the discussion we were talking about the Fed's balance sheet was to answer the question, when do I sell my gold, right? And in 1980, it was the time to sell gold because looking at the Fed's balance sheet, you could see all their credits out of the system. Right? The Fed's balance sheet is balanced by gold. That is a really, really bad time to be holding gold. That's when you sell your gold. And in fact, the FDR comment is a very good one because by 1933, all the weak banks had collapsed. Right, the Fed's balance sheet was incredibly strong because gold was flooding into it, right? And FDR really did you a favor because at that point, in 1933, the S&P 500 was yielding 10% a year, but for the top companies. Like who in their right mind would want to own gold when you can get a 10% yield in a blue chip company, right? So if you hadn't already sold gold and bought the S&P 500, he gave you a huge favor to get you to do that. Politicians usually show up, make things illegal at just the wrong time. So think about every time they talk about putting a windfall profits tax on oil prices, it's always when oil's right at the peak, and that's a great signal to get out because when politicians get around to doing that, it's probably time to leave the trade. So when gold, even in the 30s, everyone owned a little bit of gold coins. Now nobody does, or very few people do. So when the Fed or the government gets around to banning gold or saying you can't trade or you got to hand it in, things have to be really, really, really bad before that happens. And gold's going to be really, really high.
Dan, I have another question from the audience here, and
sure.
it's a little lengthy, but a very thoughtful one.
All right.
This viewer is sitting there looking at his macro trends charts right now.
Okay.
And the price of gold and the value of the Dow over the past 20 years. Okay. So he's looking at the relationship.
Right.
And he says, apart from the spring of 2009 and March 2020, the Dow has generally moved steadily upward. On the other hand, gold has had wild spikes and declines. The most favorable comparison he can make is that from 2015 to present, both appreciated approximately at the same rate. His estimate is that the most favorable circumstance for gold to reach 10,000 isn't for about 18 years. He concludes, likewise, the Dow in similar optimistic circumstances would be at 55,000 or so. So again, what he's asking is, how do you convince a stocks for the long run kind of investor like himself to invest in gold?
So
how much would you advise someone building their retirement to put in their portfolio for the long run?
Right. So again, if you think about how credit bubbles work, and again, the banks create credit, the Fed's backing them, and they grow very slowly over long periods of time. They can last decades. In the 19th century, they would last 5, 6, 7 years and collapse. Now with the central banks backing them, they can last decades, and they did. And in the teens and the 20s and the 30s was a big reckoning, and then of course we had the 50s and the 60s, and the 70s was the inflationary resolution of that bubble, and now we've had the 80s, 90s, 2000, 2010. It's been 40 years of credit bubble. And so looking at a chart that is in that time period is going to give you a very skewed view because you're looking at how prices work in a bubble. And yeah, in a bubble, the Dow is going to do better than gold. As I mentioned, gold does not like credit bubbles. It underperforms during credit bubbles. So it's you've got to look at decades or hundreds of years or thousands of years of data to understand that's what's happening. And think about, when does gold outperform? It's not random. It outperforms in the 30s, in the 70s, in 2000, when things, the internet bubble blew up, in 2008 and 9, and now, right? So it's these little waves that the Fed can handle. My point is that we were heading to a point where the Fed itself is going to have a run on the Fed. These other crises have been crises of commercial banks. The Fed has bailed them out, but now the Fed's credit is on the line, and when that happens, this whole generational bubble will unwind, and that Dow gold ratio will collapse. Now, again, saying gold is volatile, I think is wrong, because gold is the most stable thing of value that man has discovered, and that's why people have used it for 40,000 years. It's other prices moving around. It's the dollar that's volatile. It's the Dow that's volatile. And as I say, you can see this in commodity prices. When you price commodities in gold terms, they are less volatile than when you price them in dollar terms. So it still behaves as money.
So Dan, let's just pivot for a second and talk a little bit about miners, which I know you have an abiding interest in. And I also know that you're aware that gold miners, as securities, have really not performed nearly as well as the metal in recent times. I know you want to address that at some point, but I have a question from the audience, which I think is really quite intriguing. How effectively have the miners been incorporating the benefits and efficiencies of artificial intelligence, machine learning, automation of equipment and technology? Do you see the application of these newfangled technologies as influencing the price of gold in the near future? I know you had made a reference, I think, earlier to the supply of gold, right? The supply lags.
Incredibly stable.
Right. But let's get back to the technology question. Do you think is there room here for application of advanced technologies?
Well, yes, of course there is, but it won't influence the price. And as a long explanation, if you look at a long-term chart of gold versus commodities, as I mentioned, in the credit bubbles, commodities go up against gold over long periods of time. So gold mining is a bad business to be in for long periods of time, because you're getting negative margin growth. And then when the crash comes, commodities crash in gold, and then the margins explode. But there's a different underlying trend, which is, if you look at a gold commodity ratio chart over the last 250 years, commodities are collapsing against gold. And the reason, again, is strictly economic. It's because gold has constant margin utility, or near constant margin utility. It is money. And as I mentioned before, gold mining is incredibly steady at about 1.5% increase year over year, and that's been true for 200 years. So it's a very stable increase in the supply. Commodities have sharply declining margin utilities. Think about iron ore. In the 50s, a car was a huge hunk of steel. Like now there's a little bit of steel in it, and composites, plastics, other things. Think about mining iron ore. Again, the scale has gone bananas, and so it's now cheaper to mine. Now we don't think of it that way, because nominally iron ore is a lot more expensive than it was 20, 30, 40 years ago. But you price it in gold, the value of iron ore has collapsed, and that's true for copper and rubber and everything else you want to look at. And so what that means, again, is if gold mining is a spread trade between the input costs and gold, and the input costs are falling sharply, my charts show that commodities fall against gold at about 0.8% per year, compounded for 250 years. Think about that. What that means is that your cutoff grade keeps going lower. So 100 years ago, if you found an ore that had less than an ounce per ton in it, you would leave it behind, because it wasn't economical to mine. You just mined the stuff that had more than an ounce per ton. Today, the people mine underground mines, lots of them happen at 5 grams a ton, 31 grams in an ounce. So much less. Open pit mines can survive on half a gram per ton. So as this AI stuff comes into, and technology increases or decreases the cost of mining gold, what will happen is, yes, the cutoff grades will fall, and so more gold will be available. A lot of gold mining, you go back to an old mine, right? They mined the whole thing out 100 years ago. That means they left all the gold of less than an ounce per ton behind. And so you can go back, and now you can mine it again, because all that stuff's become more.
It almost sounds like fracking, right? I mean, or these other technologies that have been launched in the energy field. We're able to more efficiently process and mine.
And this is the reason why the supply gold is so incredibly stable, because you go back to the old mines and they produce more gold. So what technology will not change the price of gold, because there's so little gold out there in mines compared to the above ground supply, but it will continue that trend of falling costs in terms of lowering cutoff grades.
So Dan, we have a couple more questions here from the audience. Let me get to them in our remaining time.
Okay.
So one of our listeners wonders that since gold is not exchangeable for dollars through official channels like the Fed,
right?
In what sense is it a reserve against dollars, as I think you indicated earlier, first? And secondly, why should we care about the ratio of the value of gold to the Fed's balance sheet if it isn't officially exchangeable?
Well, I mean, again, I'll go back to what I already said, which is that you have to simply accept the fact that gold is free market money. Now, I mean, you may disagree, but I think all the evidence points that to be the case. Again, it has all the physical characteristics that make markets choose it as money. And you can see this happening over thousands of years. Free markets, evolving countries choose gold as money in every single case, gold and silver. And then in every single case, bank systems get going because they become a more liquid way to trade gold. As I mentioned earlier, you deposit your gold, you get a banknote, and that's more liquid. And then there's some crisis, and they cut that connection. And that happens in every single case. Every single bank system you want to look at, that is how it happens. And so, again, if you assume, as I do, that gold is money, then when you say, okay, what's the dollar? The dollar is a political construct. The dollar is nothing. It's just simply managed by a bunch of PhDs, right? And I don't think the Fed's balance sheet is any different than the other balance sheet. Now, it's true. One of the things the dollar has going for it is that it's legal tender, and so you need to have some around to pay your taxes and pay your credit. There's absolutely true. That creates artificial demand for it, yes, but it doesn't change the economic reality that gold is the least volatile asset class substance that exists. And so again, when the politicians use that power to create money and credit, which they always do and they always abuse, you can read the history of ancient China. Same. This isn't just a Western thing. I mean, every country is powerful enough to control money and credit does this because it's so tempting to do it. And eventually, they print too much money, they create too much capacity, they get too much war, too much spending, too much bureaucracy, too much bread and circuses, and the thing collapses. So gold is free market money. And so again, if you want to get a handle of true values, for example, oil, use gold. If you want true value of the dollar is the Federal Reserve's balance sheet, use gold. That's how it works.
Okay. So a couple more questions here.
Sure.
As I think I've said to you before, I have a 26-year-old son, and he's always saying to me, why would you even think about gold anymore? Yeah. You should be thinking about cryptos. Yeah. So the question from the audience is, cryptocurrencies will become the alternative to gold.
Yeah. No.
What do you say about that?
I say no. And I wrote a paper on this a few years ago, which I'm happy to have you send around to your village one. But just quickly, again, the function of a currency is to have the least the immediate good to make barter more efficient, right? So you can trade your stuff for something very little cost. And one of the costs of holding an intermediate good is volatility, right? You want to make sure the value is as stable as possible. Cryptocurrencies are incredibly volatile. And there's nothing that dampens that volatility. So when you think about gold, as someone mentioned earlier, when gold gets too little gold around, the price goes up. What happens is marginal mines open up, so supply increases, and people start melting their jewelry down, and so monetary supply increases, and vice versa. So the real world squelches the volatility of gold, whereas there's no parallel thing that squelches the volatility of something like Bitcoin. And it's very interesting technology, and it's great transfer technology. I mean, maybe it takes over silver's role as how you transfer value, but in terms of storing value, cryptocurrencies don't have a future. It's just one more.
Okay. So another question from the audience, Dan.
Yes.
We are 1 week away.
Yes.
I think
I'll get this question.
from having an outcome in our presidential election.
Yeah.
And given your perspective of gold and the role that it might have in the immediate future, which of the two candidates, or let me phrase the question this way, which of the two, how will either candidate impact the upward trajectory or not of the price of the metal?
So the Republican Party is people might know or might not know, is the successor party of the Whig Party, and the Whigs were around in the early 19th century. Henry Clay, and he developed what was called the American system. And the American system was to have high tariffs to encourage U.S. manufacturing, internal improvements, so building railroads, those sort of things, all to be funded by a central bank. This was the original platform of the Republican Party. And,
Yes.
and we have followed, the Republicans have followed that when in power, not out of power. Out of power is all physical conservatism and, all that great stuff. When they're in power, they spend money like drunken sailors. Think about Bush, think about Trump, right? And what Republicans do and have done for hundreds of years is they increase spending and they decrease taxes. And so the deficit goes up, and that's bad for the currency, obviously. The Fed has to buy the treasury bonds if the market doesn't and prints money. And so that's bad for the currency, good for gold. The Democrats, on the other hand, love to raise taxes on everyone they can, and they love to increase spending. And so, it's sort of a mixed bag. Yes, spending goes up, but taxes also go up. So the deficits aren't necessarily worse. In this case, however, the Democrats, if they sweep, have such a radical program, and again, it reminds me of Argentina, right? I mean, you have a rich. Argentina was the second richest country in the world in the early 20th century.
Well, in 1900, it had a higher GDP or per capita GDP than the United States.
So Perón came in as populist. There were gold bars apparently the central bank stacked from floor to ceiling. His eyes widened, and they spent it all, and then they kept printing the money spent, and the rest is history. If the whole purpose of the Constitution was to not allow one faction, which is what Madison called them, right, to take control and do this. Well, if the Democrats sweep, they're going to pack the court, they're going to have the Congress, they're going to have the president, they're going to print so much money that it doesn't matter what they raise taxes to. I think Biden's already promised $7 trillion of spending, and that's before we have more stimulus and before we have bailouts of pensions and cities, left-wing cities and left-wing states. So I think the printing is going to be so extreme that I think the dollar can't.
Okay, so a Biden victory with a Democratic taking of the Senate will accelerate this process.
I think we're also in 18 months. I think gold doesn't go to 10,000, it goes to 100,000.
Okay, so 10,000. When do we see it? So if Trump stays in office, how soon to 10,000?
I think if Trump stays in office, my guess is gold dips for a bit because it takes the Argentina scenario off the table for the immediate future. But you still have this long-term trend of lowering taxes, increasing spending, and again, that is not good for the currency and is great for gold. So the overall destination is the same. And the destination, remember, is a run on the Federal Reserve. That's the takeaway. When the market decides to stage a run on the Federal Reserve itself, so people don't want dollars, they run to the coin store, they buy gold to get the hell out of the dollar system, right? And the gold goes to a value that balances the Fed's balance sheet. That is the end game, and that's how you get to 10,000, maybe $20,000 gold. Okay,
a couple more questions here. Thank you. In our remaining 2 minutes or 3 minutes. All right, so we have someone in the audience. We need to get a copy of that crypto paper. That's the Bitcoin paper, correct?
Yes, correct. Yeah.
Okay, so we have a copy of that. We'll get that out to the members.
Right.
Here's a great question. So, Dan, back in 1987,
yes,
the Sunday night before the crash, the questioner had to buy 1 million ounces of gold for a $300 million hedge fund. Okay. It took 11 hours.
Okay.
Now that there are many, $3 billion and numerous $30 billion hedge funds, could they cause the squeeze that propels gold to 10,000? Very interesting question.
Yeah, again,
how liquid is this market?
Well, the paper market is incredibly liquid because it's like a oil market. You can create futures and all sorts of things, and it is hard to get. If you want to go buy 100 million ounces of gold physically, that is hard to do. If you're a hedge fund, where are you going to put it? In your office? It's hard to manage. So most hedge funds, big financial players, they want the paper, not the physical. But the physical isn't that liquid, but it's there. It's a matter of how fast can you get in and out of the market. It's not. If the supply is there, again, people have been accumulating stuff for 5,000-6,000 years. There's no shortage of it. What is wrong about it is the price right now is ridiculous. It's 6% of the Fed's balance sheet. It's crazy. So that number is going higher.
Excellent. Let me see. I have a couple more here. I'm squeezing. Here we go. If due to technology or discovery, gold supply started increasing at 6 or 7% a year rather than the 1.5 it currently is growing. How would that change your view of the gold equals money equation? What impact might that have on Fed policies?
Yeah, look, That's a very speculative question. I'm not sure you're going to answer it. I mean, there are asteroids out there that are, solid gold. If you went and brought it back to Earth, the gold market would crash. But then why would you do it? Because you couldn't evaluate it. I mean,
No,
I'm in the gold mining space.
But isn't this question? If you think about commodities in general, look at oil,
Yeah.
Look at agriculture. Okay, through advances in technology,
Oh,
we've been able
sure.
to squeeze greater yield.
Sure. I mean, look, that happened in the 1850s, right? I mean, you look at the gold production; it had a big leg up in the 1850s, right? And then what happened was it took a while to digest that increase, but then again, all that gold you're mining, it gets added to the above ground supply. It doesn't get consumed. It's not like oil where you're consuming it, and so you consume more when the price goes down. You're adding so that if there's some step change in gold production and you're 6%, right? Well, how long does that last? Immediately you start falling off because again, you take that 6%, you add the above ground supply. Well, next year it's only going to be 5.8%, and so it finds its own equilibrium over a pretty short period of time.
Yes. Well, I have to say, Dan, our time is up.
Okay.
It has been an absolute pleasure. Dan Oliver of Mermican Capital, thank you so much for joining us. I would encourage everyone that's on the call, Dan's contact information is up on the screen, I believe. Do we have it there? Yes, you can see Dan's email address, and we would encourage you to reach out to Dan with any follow-up questions. If you have an interest in learning more about his view of investing in gold and silver companies, I would encourage you to reach out to him or anything else. But Dan, it's been an absolute pleasure. And I do want to remind everyone that thank you.